So in the first step on our M&A model, we are going to complete our deal assumptions on the right. So I'm going to fly to the cell G11 with F5 function 5 window, G11, perfect, and calculate the percentage of cash the Google acquirer wants to invest in the deal. We see that percentage of stock is 50, so I'm going to put the formula of 1 minus the percentage of stock, and we have that. If for some reason the percentage will change, let's say it's going to be 30% of stock, I will change it here. It will give us 70% of cash, and the whole model can be recalculated based on that assumption. So the model is flowing, and we can play with these numbers going forward as well. Next is acquirer new borrowing. Here we assume that any amount of cash invested in this M&A deal is coming from the borrowing. So I'm going to make a calculation of percentage of cash invested in the deal and offer value in the cell C18. Obviously the cell is empty for now, but in the following step, as soon as we fill up that cell, the formula will pick it up, and I'll push enter. Instead of 0, there will be a particular value, right? And we will come back to it in the following step. The next assumption we want to fill up would be annual financing fee amortization. Here we know that financing fees overall are $2 million, and term of the loan is 5 years. So I'm just going to divide one by another to calculate the annual financing fee amortization. Perfect. Next is asset write-up. Here we have a book value of target assets as of 20 million and fair market value of target assets as of $25 million. And this is a very common practice when fair market is different from book value, and very often it is higher because it includes some of the industry market situation, some brands and intellectual property that might add into the market value of target assets, which is not included in the book value. So this is a common practice. So for asset write-up here, for the M&A transaction, we're gonna subtract one from another and receive $5 million. Useful life of assets is 10 years, so we're gonna calculate our incremental D&A expense as well. For that, I'm gonna take my asset write-up and divide it by 10 years to calculate my depreciation and amortization expense on this difference, on this asset write-up, which at the end of the day is $500,000. Great, we completed our deal assumptions, and our next step is to calculate acquirer and target shares information and net income standalone and pre-tax. Let's go ahead and do it.